Hello and welcome to the channel. Welcome back to the channel. Welcome to TMP Group. My name is Tom, and today is it's Thursday afternoon, early evening here in Arizona. Still sunny outside. Love this weather out here. It is the 19th of January 2022, and wow, it's been kind of a crazy day in the market today. Started out with a fantastic rally this morning for most of our stocks, and ended the day cranberry red, as I like to call it. A lot of blood in the street, but not to be fearful. We know that the positions that we hold are mostly long-term positions. The only positions that are affected is if we're in any trades or options or swing trades, and hopefully we're paying attention to those. Before I jump into everything today, I would ask you a favor. It doesn't cost you anything. If you want to hear more from the channel or hear more from myself, hit the thumbs up, hit the subscribe, hit the share. The thumbs up will help get this video out to more people. It'll help the channel, and the content will flow through the algorithms of YouTube. And then, of course, if you subscribe and hit the notification bell, I try to come on here at least once or twice on the weekdays and every weekday, and then at least once or twice on the weekend, and just talk about different ideas that we have as a group, where I see the market at, where I see it going, and what positions we're in. As the thumbnail says, we are looking today going to be looking at insurance policies for our stocks. When stocks are red, we definitely do not want to sell out of them, unless we have to, of course. And again, this is just my opinion. This is not financial advice. I'm not a financial advisor. No member of the TMP Group are professional traders. We're individuals looking to create generational wealth and understand that comes over time. So, as I was saying, personally for me, the worst time to sell is when I'm in the red, and the best time to sell is when I'm in the green. And I truly believe that you don't lose anything until you sell, especially if you're committed to your equities long term. If I have 1,000 shares of Apple and Apple drops $5, yeah, I lost $5,000, but I still have those 1,000 shares of Apple, knowing with full conviction Apple will return. So what I want you to do is take a look at your portfolio and figure out which average, whether it's the Russell, whether it's the NASDAQ, whether it's the Dow Jones, which one your portfolio most mirrors. And then we'll talk about being able to get in and put together an insurance policy that costs very little, that will allow you to make money on the red days. And so if you do need to pull some dry powder out to buy, you don't have to dip into your savings. You don't have to dip into your mattress money. If you have any, you can pull it directly from your trades that you have, and then you can purchase these stocks at a discount. And that's really what we're looking for. We're looking to purchase stocks at a discount. And if we will make our money on the buy, and then we will hold it long term. So that being said, my challenge for you is to figure out how your portfolio reacts and to which sector it reacts to. And then we're going to look at some inverse ETFs that you can either purchase, or you can buy calls on the inverse ETFs. So when the market goes down, those ETF calls go up. And we'll try to do it so it makes sense. All right, so that's what we're going to do. Like I said, before we jump into it, not financial advice, not a financial advisor. Do your own homework, do your own due diligence, and hopefully you get some education out of this. Hit the like button, hit the subscribe button, and I'll be right back and we'll talk about it. Okay, so I'm going to give you an example of my personal portfolio, which does somewhat mirror the head trading account that we have in TD Ameritrade for the TMP Group. However, I have my own personal portfolio that I manage, and if I take a look at my portfolio and look at my top 10 highest holdings in stocks, I will find that the majority of them trade as the NASDAQ trades. Okay, so for example, Tesla, Apple, Nvidia, Microsoft, Amazon, Google. Of course, I have plenty of spec plays. I put 20% of my money into growth and spec. If you saw the video earlier today on Lucid Technologies, Go back and watch that. Look at where Lucid is today and look at what my recommendation was on those puts. But my portfolio tends to follow the NASDAQ and the Russell. So Russell small cap, NASDAQ is mainly tech. So how do we protect our portfolios as the market declines? And let's assume that we're in for a volatile 2 quarters, because I firmly believe that by June that the market will stabilize, the Fed will come out, they will have inflation under control, and we will know what to expect. Again, the market doesn't like uncertainty. It can deal with good news, it can deal with bad news, just not uncertainty. So if you are heavy in the Dow, I will recommend that you look at the SDOW. That's ticker symbol SDOW. It's the inverse to the Dow. If the Dow Industrial Average goes up, the SDOW will go down. If the Dow Industrial Average goes down, then the SDOW goes up. So it's inverse. And you can buy call options on these inverse ETFs as well. And that's what I do. Now, if you're not an options trader and you don't understand options, that's a video for another time. But I'm here to help. So if you want to learn more, leave me a comment down in the comments, and I can definitely do a video on call options and put options. But they do come with a higher risk and a higher reward. And I will talk a little bit more about them towards the end of this video. Okay, so if we're in the Dow and our portfolio mirrors the Dow, then the inverse is the SDOW or the SDOW, and that's where I want to buy an insurance policy. If I am heavy in the Russell, then I want to buy my insurance policy in the SRTY. Now it's a little more risky because it is a leverage play, but I like the leverage plays. If I'm going in, I'm going all in. I want to make sure I make the most bang for my buck. As the Russell goes down, the SRTY will go up, and as the Russell goes up, the SRTY will go down. And then last but not least, if you are heavy in the NASDAQ, as I am, then I would recommend the SQQQ. So it's the inverse of the QQQ. As the NASDAQ rises, the SQQQ will fall. But as the NASDAQ declines, the SQQQ will rise and the value will rise. Now, these are not long-term holdings. They are insurance policies. And what do I mean by an insurance policy? So my recommendation is this. For every $10,000 of stock I have in a particular sector or average, I want to buy at least one, and I like to buy 3. But I would recommend buying at least one call option on an inverse and take it out at least 3 months. So right now, I am looking at, and in fact today earlier, did purchase the SQQQs in April, and I did calls that were $2 outside of the money. I did not go into the SRTY, and I'll take a look at that tomorrow and see where the Russell is. But I want to buy call options that are that far out, and each option contract is 100 shares. Why do I like to buy it 3 months out? Because I want to see, I want to give it time. I don't want to be facing time decay. And then within 45 days, if I'm still in it, I like to roll it out another 45 days. So I have at least 45 days in it. Oh, there's another one that's very popular that we've made good money on last year, and we probably will make some more money on this year, which is the SARK. So if you follow Kathy Woods and her stock, her stocks in the ARKK, the Innovation Fund, the SRAK, as those stocks decline or that fund declines, the SARK will continue to rise. So it is a very inexpensive way of covering your positions because, once again, let's take Lucid as an example. Lucid Motors. If we see a decline in Lucid Motors of 10%, I want to make sure that I have a position that I can cover that with. In Lucid's case would be a put option on Lucid. And then as Lucid drops, that put goes up, and I can pull money out of that put to buy more Lucid shares at a reduced price. All right, so let's go over them again. If our portfolios are heavy in the Dow, and you'll have to find out where yours is, I recommend the SDOW calls 90 days out. If we are heavy in the Russell, I recommend the SRTY calls 90 days out. And if we're heavy in the NASDAQ, I recommend the SQQQ calls 90 days out. Now, again, I believe that for every 10,000 we have invested in those stocks, that one option is enough. I like to trade and buy 3 options at a time, whether they're puts or calls, because that way I can shave on the way up and I can mitigate on the way down. But hopefully that helps out. We can make money in a down market. We can make money in an up market. We just have to know how to work the market. Today, like I said, I personally got into SQQQ, 90 days out, $2 outside the money, 3 positions right there. If your portfolio is balanced and you are in the Dow and you are in the Russell and you're in the NASDAQ, and they do overlap sector-wise, then take a look at getting, maybe 1 call option on all 3 of those, or 3 call options on all 3 of those. 9 is a perfect number. It really is. And for those of you that have followed my options trades, I like to trade in 9s. That way I have 3, each 3 is a third. And it really helps us to make some moves and make some money. So that's what we're here for. We're here to make money. Just know there is an insurance policy out there that you can get in the form of an inverse ETF. You can either buy the shares of the inverse ETF. That's not my recommendation. I recommend getting into the calls of an inverse just to protect. And as our stocks go down, if we're seeing some volatility, those inverse ETF calls will increase, and it will allow you to hold on to your shares and don't sell when they're red, because when we sell when they're red, we've lost the game, right? The only way that Wall Street can make money is volatility. Stocks have to go up and they have to go down so the Wall Street traders can trade in and out. I personally, for number 1, do not consider myself a trader. I consider myself an investor. I do believe, and if you haven't seen the videos I've put out about becoming a millionaire in 10 years, it only takes 10 years to make your first $1 million. So go back and watch those. Hit the like, hit the subscribe, share the channel with others. Most importantly, invest in yourself. Invest in your future, invest in your children, invest in your children's children. If you do not have a wealth chain started, start a wealth chain today. It doesn't matter how much money you put into the market, just put something in and continue to dollar cost average into your high conviction stocks. There's a lot of good information on YouTube. There's a lot of good information on my channel. There's a lot of other good YouTubers. But do your research, do your own due diligence. Don't ever take any of our words for it. Become your own best consultant and stick with it. And hopefully you stick with the channel and you find prosperity. We're looking for just a fantastic 2022 and beyond. I appreciate you stopping in today. I appreciate you following the channel and liking the video. And I do hope everyone has a great day.